So, Chapter 3 delves into a subject that is a little bit tough for people to deal with at first. And the main takeaway from Chapter 3, I think, has to deal with this appreciation for accrual accounting and what that means versus cash basis accounting. Most of you probably are used to cash basis accounting in terms of how you just manage your personal finances. So if you pay for something, that's an expense. If you receive something, that's revenue. It seems pretty straightforward. But accrual accounting is more precise because it doesn't just focus on cash movement, it focuses on economic transactions, the economics, the essence of a transaction, what is given, what is received, whether it be cash or not, there's some sort of economic value. So we're going to get into these. And the first learning objective talks about what accrual accounting is and how it differs from something that most people are pretty familiar with, which is cash basis accounting. Accrual accounting is, like I said before, it's primarily a means of recognizing the economics of a transaction. So when you think about economics, we're primarily concerned with the financial impact of transactions, cash and non-cash. So what that means is that there are certain things that impact us financially that don't necessarily involve cash, at least right away. But most importantly, accrual accounting doesn't ignore cash. What it does is that it recognizes the financial impact of cash either before or after cash moves. So you can pay for cash later or receive cash later, but right now you can recognize the expense or recognize the revenue. Likewise, if you pay cash or receive cash up front, it doesn't necessarily mean that you had an expense or you had revenue. Maybe the event to which the cash relates happens later, and that's what accrual accounting does. It primarily handles the timing differences between when a transaction occurs and when cash actually moves around. So the authors do a good job of acknowledging that accrual accounting does take into account cash transactions, collecting cash from the customers or receiving cash from like a portfolio of securities, paying salaries, borrowing money, but it does more than that. You can incur expenses related to salaries, for instance, even though you haven't yet paid them. So you would still want to record an expense even though you haven't yet paid for the cash. Likewise, you can also record the revenue, interest revenue or dividend revenue, if you own stock or bonds that pay such financial rewards. You can record that before you actually get the cash. So accrual accounting does take into account cash basis transactions, but it does more than that as well. The author's talking about the time period concept, just trying to remind you that really we're focusing on a time that has a distinct beginning and a distinct end. And I think that's worth actually mentioning here is this time period concept. There's a distinct beginning and there's a distinct ending. And that is how we determine the performance. Really what it comes down to is determining performance. Because if we don't have a clock of some kind, we can't really judge a person's performance. So you think about basketball or football. There's a kickoff or a tip-off or some type of beginning, and there's definitely an end. And at the end, you decide you can find out clearly who's the winner and who's the loser. Well, the time period concept is no different from that. There's a distinct kickoff and there's a distinct end. Now we've touched a little bit on revenue and expenses in class, and I think a lot of people get this from a personal aspect. Revenue is financial amounts that we've earned. We've done something, we've exerted effort, or we've given away some of our other resources for something of value in return. And whether that be cash or a promise to receive cash or even if we receive something of value in general that rewards us for our efforts, that would be considered revenue. Expenses are like the consumption of assets. So when you think about, for instance, your cash, when you go out and you go to watch a movie, or if you pay rent in advance, expenses are either consumed immediately or over time. And whether or not we recognize those cash outflows as an actual expense depends on whether or not we consume them immediately or over time. Revenue recognition principle. This is a hot item in accounting because while you and I can think of a lot of times where we've earned revenue, or when a company like a coffee shop has earned revenue, there are still a lot of confusion about what constitutes revenue and when to, more importantly, when to recognize revenue. So I want you just to remember this, that revenue is recognized when it is earned. And I'm going to underline this because that's the key aspect of it, earned. Now, what constitutes earning something depends on whether or not the performance has been fulfilled. So when you think about your job, you show up to work, you punch the clock, you do your thing, and then you clock out. Okay? By the time you clock out, when your boss says it's quitting time or you're free to go, or whatever you do, at that point, all your work has been recognized. And you can actually, for your own personal records, record a receivable because why? Because there was an expectation in the beginning of the day or the beginning of your shift that you were going to work for pay. And you've done that work, and your boss says, now it's time to go. I don't need you anymore. You've done your thing. Out the door you go. At that point, your boss is basically acknowledging to you that you've earned your pay. And so you may not get paid cash right away. But the point is this. If there's an acknowledgement by the individual, the person you're working with, the other person at the end of the contract, who's saying you've done what's been expected of you. You either delivered the goods, you've created the goods, or you provide the service, then at that point you can recognize those earnings even if you haven't gotten the cash yet. So if we recognize revenue when it's earned, we recognize an expense when it's incurred. So go ahead and we recognize expenses are recognized when they are incurred. What do I mean by that? Well, it's quite simply this. You may not, for instance, your phone bill. Maybe you get your bill in the mail, and when you get your bill, maybe it's not just your phone bill, maybe it's a utility bill from the power company or the water company. And they say, here's your water usage, or here's your power usage for the past month. Well, that may not come until the 5th of the following month, but at the end of the previous month, on the 30th or the 31st, you've actually incurred an expense. In fact, even when you turn on the lights of your apartment or your home, as soon as you start consuming someone else's resources, you are incurring an expense. You need to recognize that there is some benefit that you are enjoying, even if you haven't paid cash for it yet. Now, of course, it seems pretty intuitive by now that if you have more revenues than expenses, you have net income, or the opposite, if you have more expenses than revenue, you actually have a net loss. But keep in mind that just because a company, for instance, has a net loss, that does not mean that they've paid more cash during the period than they brought in cash. It just simply means that they've recognized less revenue than they have expense. In fact, it's possible, and you don't have to worry about this just yet, but I'll make sure this is clear come chapter 12. It is possible for a company, even you, to have a net loss, but still have cash, positive cash inflow from your operating activities, which essentially is to say this: if we looked at certain companies have financial statements, and if they have them restated in terms of cash basis rather than accrual basis, we might find that they would actually have positive net income on a cash flow basis. It's possible to have that, but keep in mind there is a timing difference between when cash is paid and when cash is received versus when expenses are incurred versus when revenue is earned. So before I jump into learning objective 3, let me open up an Excel spreadsheet to discuss what I mean by this, and you can follow along with me. In chapter 2, we talked about journal entries being recorded. Journal entries are the way we recognize that a financial impact has occurred and it's impacted us. So in the case of when we have paid cash, for instance, for rent, so we would debit rent, prepaid rent, and we would credit cash. Now, we call this prepaid rent because really it's an asset. So don't necessarily think that because you have spent cash of some amount that you've actually incurred an expense. So if you pay, for instance, at the beginning of the month, $300 for your rent, that actually goes on your balance sheet, if you believe it or not. So we have assets, liabilities, and then equity. Now, expenses will reduce our equity, but for the time being, we can simply say that cash has gone down and a prepaid item of some kind has gone up. Well, that's good. For $300, that's darn good, because we don't necessarily want anybody, especially ourselves, to think that we're poor, or less wealthy of $300, when in fact we have the right to receive the use of a facility for a period of time. So if you want, you can go ahead and draw these T accounts. I'm going to go ahead and show you how I do mine. So for instance, I have this quick access toolbar up here that allows me to quickly draw in some T accounts. And if I say started the period with $1,000, okay, and I pay, in this case, $300 credit cash, so go ahead and say that, I'm not poorer or less wealthy by $300. I've just changed my cash from one thing to another. So I actually now have $300 of a different type of asset. And let me see if I can go ahead and insert some columns here. Take this, insert that. I'm a big fan of Excel, and so hopefully some of these items, these things I'm doing, hopefully you can learn a few things here that will help you distinguish yourself on the job market. If you want to learn more, just let me know. So on the equity side, we have retained earnings, and retained earnings is, well, it's kind of challenging to truly understand. Embedded in retained earnings, RE, are the effects of the income statement. So if you want, go ahead and just put over here revenues and then do the same for expenses. You'll learn about how we take these different accounts, like for instance service revenue. We perform service for somebody, or rent expense. You'll learn about how we close these accounts out and put them over into retained earnings later. So for right now, we haven't really incurred an expense. We will at the end of the month once this rent has been consumed. So if you think about, for instance, October 1st, 10/1/2016, at that point in time, we have basically just shifted our assets from cash to prepaid rent. But come the end of the month, what we're going to do is, at 10/31, we're going to reduce our prepaid rent account. We're going to credit this account, prepaid rent, for $300. And at this point, we're going to go ahead and debit rent expense, because that demonstrates we've actually consumed this asset. So even though we paid cash a month ago, it was not an expense. It was sitting in another type of asset account called prepaids, prepaid rent in this case. And so now all we're doing is simply saying we're going to get rid of this 300. In fact, let's just do this. Credit prepaid rent 300, and then over in our expense account, rent expense, we're going to show that debit over there. So what are we left with? Overall, we're left with $700. We have $700 cash. We have 0 prepaid rent, and we have incurred a $300 expense. So basically what has happened is our overall assets have decreased, credit there, by 300, and our overall expenses, our overall equity has also decreased by 300, because this 300 is ultimately affecting or going to affect retained earnings. So these accounts right here, they're sort of embedded in retained earnings. I just don't like how the authors present that. So if you want, go ahead and put over here the 300, but make this like a little bit lighter gray so that way it doesn't confuse you. We're less $300 over here, and we're less $300 over here, but it's showing up as a debit rent expense, not debit retained earnings. Let's move on. So the trial balance is really where all the accounts are going to show up and demonstrate to us a couple things. One, total debits will equal total credits. And two, if there's any weird balances in these accounts, they're also going to stick out like a sore thumb. In Chapter 2, they talked about how any type of asset account is going to have a normal debit balance. Well, if we see something over here in the credit column, it means that something weird has happened, and we need to go back and make some sort of adjustment. So that's why they call this an unadjusted trial balance, because chances are there's something in assets or something in liabilities or equity that needs to be adjusted. It's quite possible, for instance, that the salary expense account you see down here, 900, needs to be adjusted for whatever work our employees have done but haven't been paid yet. It's also possible that some of the $7,000 revenue doesn't include any work that we've performed that we have not billed to our customers yet. So we need to look at these numbers as just something that we need to scrutinize over very, very carefully. So when we're thinking about the different types of accounts that need to be adjusted, we're primarily focused on deferrals and accruals and depreciation. Now, depreciation is similar to a deferral, but the authors break it out into 3 categories. I would simply say this. Deferrals are essentially like rent expense items. So when you think about, if you went back to your Excel spreadsheet, and I gotta find mine here. If you went back to this Excel spreadsheet, prepaid rent is a deferred expense, meaning that we initially paid out cash. It's left our pocket, it's left our account, it's left the business's cash account. But we still get some sort of, we're still able to derive some sort of benefit from it. So it's not an expense yet. It will be an expense, but for right now we're deferring that expense. It was a cash outflow, but not yet an expense. First it ends up here, and then later at the end of the month after we've consumed it, it then ends up as an expense. That's why we're saying is even though cash is left, we're deferring the recognition of an expense. So going back to deferrals, we need to adjust deferral accounts for circumstances where we have paid cash but not yet recognized the expense. And so really this is on us to remember, because nobody's going to remind us that we have to adjust these accounts. These are just simply accruals that we made that need to be recorded once they are used or earned. Accruals, when it comes to the 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 delayed recognition of a cash flow, these items happen when cash has not yet moved. So these are a little bit more difficult to grasp and also remember or just account for, because when deferrals occur, cash has moved. Either cash has come in or we've paid out cash, and so we can see that. We can we can feel that effect when cash moves around. But accruals, cash hasn't moved yet. And the classic example of that is when we have, say, sold something on account. So when you think about, say, for instance, sometime during the month, say it was on the October 20th, we had sold some services. We performed some work, right? But we didn't get any cash for it yet. We'll get paid sometime in November. Okay, fair enough. So at the end of the 20th, let's say we've earned some service revenue. We'll go ahead and credit service revenue, even though we didn't earn the cash yet, or we haven't received the cash yet. So for us, that's a receivable of some kind, meaning that we're going to receive it sometime in the future, hence the phrase account receivable. So just type in account receivable. Now, if we perform work for, say, maybe we have like 2 or 3 part-time jobs, maybe we have a different account receivable from each different employer, in which case we would want to make sure this is titled employer A and employer B. For right now, let's just assume we have one job, one employer, in which case we have to recognize that, hey, even though we haven't been paid yet, we are still owed some kind of amount. So type in account receivable and go ahead and debit that. And then over on the service revenue side, go ahead and recognize the credit for service revenue. You worked your butt off. You've earned that money. So you can go ahead and record that revenue. But even though you expended effort, time and effort, you didn't get cash yet. You're going to get cash in the future, but you haven't gotten the cash yet. So you're just going to recognize that. You're going to accrue that amount. The cash will come later. And then sometime down the road, maybe it's on 11/5/2016, you actually get the cash, in which case you'll go ahead and debit cash. And then guess what? You'll credit that account receivable. You're giving up that claim to that cash. So in this case, let's actually get some different numbers here. Let's say you've earned $150. That's kind of weak. Let's say you've earned $550. Let's make it more exciting. You've earned $550, but you haven't quite received it yet. Later on, you'll get the $550, hopefully. And at that point, you no longer have a claim to $550. So you have to credit that account receivable to get rid of it. But you get to recognize, hey, guess what? You got some cash. So it's party time now. That is accrual accounting. You have some deferrals, you have some accruals, but cash moves earlier, cash moves later. It doesn't really matter if cash moves. If something has happened to the business or to you, even if cash has not moved yet, you still have to recognize the revenue and expense. So on the retained earnings side, we're already looking pretty good. If you think about the net, for instance, the net credit and debit here, this basically shows that we would have if we were to construct an income statement, this would show that we have net income of $150, or excuse me, $250. That's awesome. Okay, more fun for us. Now depreciation is a little tricky because I kind of look at depreciation as something very similar to deferrals. So if you want, go ahead and just sort of draw a box around deferrals and depreciation, because they're kind of the same thing. The key about depreciation is that it's mostly the recognition of an expense for something we paid in advance, but this happens over several years. So think about in the case of your computer. Go back to your Excel spreadsheet. Let's say on 10, 9, well, let's make this a little bit simpler. Let's say at 10/31/2016, Halloween, you went ahead and bought yourself a new computer. It was not a Mac. It was like a Lenovo, for instance. So debit equipment, and call it subheading computer. And let's say you paid cash for it. Let me think about this. Let's make it a little bit more complicated. Nah, we'll wait for that later. Cash. We'll pay cash. And let's say we spent $750 for it. And where does that leave us? Okay. So we're basically going to record the outflow of cash. $750, right? Actually, let's just do this. Equals cash. And we're going to set up another asset account to recognize that we have something else of future economic benefit called equipment computer, CPU. So we're basically taking $750 of cash and changing it into equipment. It's just basically moving cash around, but we still have the same amount of assets in total. Now, if we expect to use that equipment over 3 years, if we're going to get 3 years of life out of this equipment, how much per year would we actually recognize? Okay, to kind of keep this sort of simple, let's change this to January 1st, 2016. And now let's say we're at the end of the year, 12/31/2016. So 1 year has gone by. So 1/3 of this computer has been consumed, if you will. The thing about depreciation is we can't quite see it, right? So we can't reduce the equipment account like we reduce the prepaid rent account, because it's all theoretical. But there's still some sort of wear and tear in all this that we have to worry about. So what we're going to do is debit depreciation expense. We're going to credit not equipment, because if we were to credit equipment, it would literally mean that 1/3 of our computer has disappeared. Okay, it has not disappeared by 1/3. We're going to set up a contra asset account. Contra meaning opposite of, and asset meaning of the asset account. So here I'll put down accumulated depreciation equipment computer. And what I'm going to do is set up a contra account right below my computer equipment account. Call it accumulated depreciation equipment computer CPU. And what I'm going to do is, rather than reduce this account, I'm going to set up a credit balance account that will net or offset the $750 to reflect the fact that the overall equipment value has gone down. So how much do I do that by? Well, $750 over 3 years. We take this divided by this. Every year, $250 will be expensed. Even though the asset has not gone away, it's just purely theoretical. We've consumed $250 worth of use out of our computer. So go ahead and fill in here $250 and fill in here the same amount, $250. Again, the computer is still in existence in full, but we're just simply acknowledging the fact that it's kind of losing its usefulness by 1 year. So 1 year has gone by, and we're just simply recognizing that its value is 1/3 less. It's purely theoretical, and that's okay. So how do we record that? Depreciation expense. All expenses are debit. So let's go ahead and go over here, set up a depreciation expense account, and we'll go ahead and record debit $250, which means we need a credit of $250 down here. So you can kind of see that these debits and credits are kind of making sense. They're just sort of left side, right side. But overall, if we're just going to pay attention to each individual transaction carefully, we won't miss anything. It's just a matter of time before all these accrual transactions, these deferrals, these accruals, and these depreciation transactions ultimately end up as a cash outflow of some kind. But mind you, remember that we've spent $750 in cash. We're only going to recognize that $750 as an expense over 3 years. So go ahead and copy this transaction, this depreciation expense, and post it 2 more times, only this time put 2017, put 2018, and guess what? It's the same transaction. We're only going to recognize $250 every single year. So by the time 3 years is up, we'll have $250 more of depreciation, $250 more of depreciation, which amounts to how much? A total of $750. So equals sum of this, 750 bucks. That represents the amount we paid for the computer, but we didn't recognize it as an expense all at once. We just recognized it as an expense at the end of 2016, a little bit more in 2017, a little bit more in 2018. We're spreading the expense across multiple periods. We also have to record the accumulated depreciation. Okay, so 250 more there and 250 more there. So guess what happens at the end of 3 years? How much is that computer valued at? So equals sum of this. $750 is the asset value, but the contra account has $750. So the overall equipment account is worth 0, because what we're going to do is when we report this information to our investors on our balance sheet, we're going to show equipment, computer equipment, net of accumulated depreciation, total value, total net book value of 0. When we first bought it, this account was 0 as of January 1st. At the end of 1 year, we had $250 of accumulated depreciation, so the value of our computer after 1 year was $500. Our value of our computer after 2 years was $250. And then at the end of 3 years, the value of the computer is worth 0. Now, if you think about it, your laptop, if you've ever owned a computer or a laptop, and after 3 years you decide to get a new one, it kind of makes sense that basically the value of your old computer is worth 0, which is how we value fixed assets. We cannot see them disappearing like we can, say, prepaid rent or supplies that we have in our closet or our food cabinet. So keep that in mind, that depreciation is more theoretical. We know that there's a reduction of value. We just can't see it, but we still have to record something. So when we go back to these categories of accruals and deferrals, what we're simply saying is deferrals, these are things that we can see disappearing. Rent is gone at the end of the month. Why? Because a month has gone by, so it's gone. So therefore the value of our rent is 0. Our prepaid rent is 0. But has the value of our computer actually gone down because of the passage of time? Yes. Even though we can see it, it's still there in full. Maybe it's just not worth as much. We have to record some sort of expense. Accruals, if something has happened to us, even if we haven't paid the cash out, we would still have to record something. So the authors go into prepaid expenses. These are deferrals. So when you think about these, just go ahead and remember that they're still deferrals. Prepaid expenses are deferred expenses. So at first they appear as an asset, then later they show up as an expense. So cash moves first, but we don't recognize an expense right away. First it shows up as an asset, then it goes in as an expense later. This is just like our rent. Going back to our prepaid rent, It shows up as an asset first, moves from cash down to this asset account, went from one asset account to another. Then later we get rid of it because it's been consumed as rent expense. By the way, let's go ahead and adjust this. If you ever get a chance, practice with Excel a little bit and learn these little tools like Format Painter. If you like the format of a certain cell, you can double click this Format Painter under the Home key and just multiply that over and over again. Go back to deferred. There we go. So prepaid expenses are still assets after they're consumed over time, then they'll show up as an expense. So in the case they give in the book, they talk about prepaid rent, $1,000. Cash they paid was $3,000 overall. So they're paying 3 months, $1,000 per month in advance. So you only pay usually 1 month in advance, but in business, you can pay between 3, 6, 9, and 12 months in advance. That just depends on your negotiation with your landlord. But notice how, again, cash went down, but we didn't show an expense yet. We have not consumed it. It's June 1st. The real question is, even though this is still an asset, what do we do as we consume it? So at June 30th, they say, look, 1/3 of that $3,000 has been consumed. So we need to reduce this prepaid rent account by $1,000. So we go into prepaid rent. We start off the month with $3,000. We've used $1,000. Now we have 2 months worth left of this asset. So where does the $1,000 go? Well, it goes as an expense. We've actually consumed some sort of benefit from this. Supplies are very similar too. So you think about, you go grocery shopping, you buy, or go to Costco, for instance, you buy Doritos and crackers and big blocks of cheese and whatever they were, selling in the aisleway that smelled really good, and you bought some of that and you're walking away like $700 we paid for groceries. Oh my gosh. Okay, but is that necessarily an expense? No, not yet. It will be an expense after you consume it, but for right now, you basically just turned your cash into a different type of asset. So we call it supplies. Well, guess what happens once we consume supplies? If we go back into the cupboard a month later and we see that there's only, maybe what we see is about $400 left of our $700 purchase from Costco. What does that mean? It means that we must have consumed $300 worth of food. So credit supplies, the asset account goes down. And where does it go? Supplies expense. All right, so that's how we recognize the expense. Now the authors start talking about equipment and other plant assets. I've already talked about your computer being an example of this, but for right now, let's go ahead and I want to bring up these different phrases. I might say the phrase property, plant, and equipment. Or I might use the phrase fixed assets. So go in here and type fixed assets. Okay. The authors call these plant assets. And again, the whole idea behind these phrases is not to confuse you, but these are just terms that basically mean the same thing. There's something tangible, right? Tangible property. So in your case, you may have a computer, you may have a bike, right? You may have your clothing would be considered part of your fixed assets. Why? Because you're going to consume it over the long term. Tangible property that you consume over more than 1 year. That's the key aspect of it. Supplies are things we would consume if we go back. These supplies, we expect to consume these within a year. Otherwise, that cheese is going to spoil. Those chips will go stale, right? So you're going to plan to consume these within a year. But plant assets like your computer, your bike, whatever, you're going to use it over multiple years. The other distinguishing feature between supplies and plant assets is that the value, the decrease in value is theoretical. So decrease in value is theoretical. Can't see it. Versus, if you go back to supplies, the decrease in value is actual or real. We can see it. You can see that your supplies have disappeared. Same thing for your rent. Your rent has gone away. It's gone. You may not see your rent, but if you've let a year go by or a month go by, that calendar is now moved on. You can get rid of that prior month. You can see that time has gone by. So it's still very much about seeing things of value on your assets that has gone away. The tricky thing that people have, the tricky part about depreciation is that people don't really see value going away. Just because a year has gone by, their computer still works, their bike still works, their clothes still fit, hopefully, but there's still a decrease in value. How do we recognize that if we can't see it? The answer is depreciation. We just simply come up with a theoretical amount that represents a decrease in value, but we have to be careful with how we do it. So the way we deal with it is we don't reduce the account directly. We set up this contra account down here, which offsets the gross value of what we paid, and then every year the net book value overall gets smaller and smaller and smaller. All right, so the authors give you a pretty bland example. Equipment, $24,000. Think of this as like your car, okay? You bought a car, $24,000 on June 3rd. Fair enough. Now you have to figure out, well, how much value is going to go away every year? Well, there's a couple things you need to do when it comes to calculating the depreciation, and I think it's probably useful to sort of insert a new slide here. So let me go ahead and just insert new slide, and it's blank. And what I'm going to do is I'm going to do some drawing here. Okay, so if you've got this timeline here, and by the way, the little shortcut keys I'm using. If you want to draw a horizontal line or a vertical line or even a 45-degree angle line, hold the shift key down when you click and drag. That way you get a perfectly level line. I'm going to make this, screw it, I'm going to make it orangish. There we go. And let's see, let's make it thicker right there. And so I'm going to make this my default line for right now. Sign is my default line. So that way when I draw a new line, it's sort of like keeps it the same color. Control C, V, moving on here, Control C, V, here. And you kind of get the idea what I'm trying to do. I'm trying to create a timeline is what I'm doing here. I'm not doing a very good job, but thankfully you can just fast forward through all this nonsense until it makes sense. Okay, so what I've done here is created essentially 5 chunks, all right? So 1, 2, 3, 4, 5. I'm going to use this car over 5 years in total, right? So going back to what they're saying, 5 years at $24,000 original cost, that means every year $48,000 per year I'm going to recognize as depreciation expense. So annual depreciation, this is the amount I'm going to record as depreciation expense. So go back down here and insert a text box, $4,800. There you go. And this Control C, Control V, Control V, Control V, Control V. This is how much I'm going to record every single year as an expense. Now, I'm not going to reduce the value of the actual asset itself. I'm just going to say, look, I'll set up a theoretical account that's going to capture all the theoretical wear and tear, not the actual wear and tear, just the theoretical. Maintenance expenses such as new tires, Oil changes, fan belts, things like that. Those are just maintenance expenses. Those are just things you pay for in cash that you have to record as some type of miscellaneous or maintenance expense. But the actual car itself is not disappearing. We just need to set up some type of contra asset account. So they start up here and they say take the 24,000 divided by 5, which accounts for $4,800 per year. Now here's the trick, and don't screw up on this on an exam. Notice the time we bought it was June 3rd. Okay, so how many months have gone by? Well, they do a monthly depreciation calculation where they simply say, well, $4,800 per year is essentially $400 per month. So what do I have to do? Take this $4,800 and divide it by 12 and calculate the monthly rate. So I'm going to do this, Control C, Control V, and I'm going to say $4,800 divided by 12 equals $400 per month. Okay, and I'm going to blow this out a little bit more, like this. And the real question is, so when do I record this $400 worth of depreciation? Yeah, you can record it at the end of the month, or you can record it at the end of your fiscal year period. So the way the authors record it is at the end of the month. So here's June 30th, record depreciation expense of $400. Do not reduce the actual asset itself. It has not disappeared. So how do you record that credit? You don't record it to the actual equipment account. You set up this contra asset account where you record that credit, just as we did over in my Excel spreadsheet here. Equipment was $750, but I didn't record the credit here. I put it down here in this contra account because a contra asset account implies that there's a theoretical decrease in value of the overall equipment itself, not actual. So they record the $400 every single month, and then at the end of the fiscal year, they look and see how much total depreciation has occurred, and they net those off just as I've done here. That's how they do it, every single period. The accumulated depreciation account is a contra asset account. What that means is whatever the normal balance is in assets, which is a debit, the contra asset account has a normal credit balance. So when you think of contra asset, you're really saying what is contrary. Let me go back, put my little notes in here. Control C, Control V. Contra. Contrary or contradicts, right? Things that are opposite. What is the opposite balance, normal balance? In this case, for assets, the opposite of the normal balance. So in the case of assets, an asset has a normal debit balance. A contra asset then must have a normal credit balance. That's what they mean by it. It's just simply a means of offsetting the associated account is equipment. So we create this sort of like tag along account and say that these basically influence each other, but that's it. They don't really, beyond depreciation expense, they really don't do too much else. So the accumulated depreciation just keeps a track of what theoretically we would credit if we actually saw the account, the actual asset disappearing. So if we move on, they demonstrate how on the company's balance sheet, if you will, there may be this little bit of a calculation where they show the land value of 18,000, equipment of 24,000 gross, less accumulated depreciation 400. There's a variety of ways that this might show up on a company's balance sheet. Sometimes they just put it in parentheses. So what you might see, for instance, if I were to sort of draw out a lot of different varieties here, is that you look at a company's, get rid of that. Go back to my Word document here. Back. On a company's balance sheet, when you see the financial statements, of course, they'll start off balance sheet, and they'll talk about assets and current assets, right? And the first one they'll talk about is cash. They go AR, etc., etc. They'll get down to their non-current assets, and they'll have this. They may have land, but land doesn't depreciate. We don't worry about the decrease in the value of land, and there's a variety of reasons why, but we'll talk more about that, I think, in chapter 6. But if you have buildings, equipment, things that wear and tear, in this case equipment, what they'll probably do is they'll probably show this equipment less accumulated depreciation, and they'll probably even say how much it was. So in this case it was $400. And then over to the far right side where they start to show the amounts in the balance sheet, that's where they would simply show the $23,600. So this is a pretty typical way you would actually see how a company would report the net book value of the equipment itself on the balance sheet. The authors present it in this sort of broken out way. Maybe this is shown in the footnotes of the financial statements where they start to talk about in more contextual terms what's in equipment. Does equipment mean, for instance, printers and computers and other types of hardware? Equipment can mean a variety of things. That's why we have footnote disclosures that talk in more detail about what we see on the balance sheet. So this is a more typical way that you would see the accumulated depreciation being recorded. So accrued expenses are basically, again, we've incurred an expense and cash may not have moved. So the classic example that the authors love to use is salaries expense or accrued salaries expense. So in this case, you got somebody who started work at the beginning of the month and their payday was, for whatever reason, it was Saturday, and the end of the period, the 30th, was a Sunday, but they don't pay until the next month. So it's kind of a weird situation, but I think you can kind of get it that if, for instance, and maybe what we can do is sort of draw out a rectangle here to sort of demonstrate what the real working week looks like. So let's say for instance, a person, and let's format this to make it a little bit more transparent. And let's make it yellow. And let's make it like 75% transparent. There it is. Okay. So here we've got a work week. And they get paid, let's say, half of that. So this is a monthly salary of $1,800. So this right here would be worth like $900. So if you want, do a little cute call out here. Have some fun with this, for crying out loud. Say, pay me my money. And this would be like $900. Okay. Now, they probably don't get paid until the 17th. So payday might actually just be, you know, set as my default here. I like saying default shapes. Let me pull open my fancy dancy little cheat sheet here. Payday is probably on the 17th. Okay. So on the 17th, what you would see is, let me sort of draw this out on my spreadsheet. On, what day is that? June 17th. So on 6/17, 6/17, there we go. They would debit salary expense and they would credit cash. But that's not the amount that a person worked on the 17th. That's how much they worked from from this period basically. So there's a bit of a delay in terms of actually paying out the cash. What happens though, so in this case, what was it, like $900 I said? Let me shrink this down. Let's move this bad boy out here. So we got $900 and $900. Well, what happens if on, say, July 1st, 7/1, that's when the company actually pays the salary. Well, what you would see is, and let me add some spaces here, you would definitely see some type of debit and some type of credit, and it would involve cash for the other $900. Okay, but we don't wait to record salary expense on July 1st. We need something else on 6/30. We need to record a debit, and we also need to record a credit. And the reason why is because we follow that time period concept. So if you go back to that earlier slide, when they talk about what this time period concept is all about, where is that sucker? Holy cow, I can't even find it. There it is, time period concept. They're basically saying, look, well, in this case, at the end of every month, we've basically got an appropriate cutoff period. We may perform services or do business from January 1st through December 31st, but at the end of a month, we may have to report to our investors what our performance was for that month or ever since January 1st. So at the end of every month, we need to make sure that all of our books are updated. We can't delay and wait to recognize an expense in July if in June we've actually incurred that. And the reason why we know we've incurred it is because when you go back down to that calendar, people have worked for us for another 2 weeks. So this is another $900 that we have incurred. How do we record this expense if we don't pay them until, say, oops, let go. Whoa, holy cow. Grab it, grab that red. If we don't recognize that until the 1st, imagine this is July 1st right here. People have worked for us for 2 weeks. So we've incurred $900 worth of expense. But we don't pay them until here. We need to record something as of the 30th. We need to record an accrual. Cash will go later, but we need to record an expense now. How do we do that? So on June 30th, what we're going to do is we're going to go ahead and say salary expense, but we're not going to credit cash. We're going to credit a liability. Salary payable. Just like account payable. It's some type of amount we owe. Even if we pay it the next day, we owe it as of right now. For how much? $900. So, at the end of the month, we will have this. We will have how much in expense total recorded. Salary expense. Debit 900, debit 900, or a total of $1,800. So at the end of June, we will appropriately have recorded the total amount that we've incurred as an expense of $1,800. The only difference is some of that will have been paid in cash. So grab this here. Paste values. Oh, that sucks. There we go. This, let's assume we have cash of, say, $5,000 at the beginning of the period. We have paid out $900 of cash. And we've incurred a liability, cash, salary payable of $900. That's the other credit. So there's the credit there. There's that credit. There's that credit. And that's the total of this debit and this debit. The next month, what we're going to see is build this out a little bit here. another $900 going out. And because we will have paid off that obligation, we will be debiting salary payable for how much? $900. Then that liability disappears. It was this, and we paid it off. We no longer have that obligation. So let me adjust my cash account here. So just to recap, we incurred a total of $1,800 of expense, and we recognize that on our income statement. That's appropriate, but the offsetting credit, some of it was paid in cash, and the other one, what we gave was a promise. We gave cash, half of it was a promise, half of it was cash. There's the promise. At the beginning of the month, we will have made good on our promise, which gives us relief. We got relief, debit the liability, we got some relief, and that relief cost us $900 basically. So ultimately, again, I think this illustrates kind of an important point. Just because there's a timing difference between when cash moves and the time when we record revenues or expenses, ultimately we will record everything in cash. It's just a matter of time. Sometimes cash moves first, sometimes cash moves later, as in this case. So hopefully that kind of illustrates this notion of accrued expenses. We basically are going to incur a total of $1,800 for the month of June. We want this month to show $1,800 of expense. That means we need to show either all of it paid in cash or some of it paid in cash and some of it showing up as a liability. Here they demonstrate that in more detail on June 15th. They record the salary expense. There's the cash. And then at the end of the month, they're going to record salary expense again. There's a total salary expense. And then they're going to credit the payable, not the cash account. The following month, they'll record the actual cash payout, but you have to presume that they're going to do that. Accrued revenues is no different. If we're selling to people on account, and let's go back to my spreadsheet here. Let's go ahead and do some copying of these accounts. Control C. And let's do this. Delete this. Delete it. Let's just copy this spreadsheet. Move it over. Now we're talking about something different here. Now we're talking about selling on account. So we get cash later. So how are we going to do this? Let's delete that. Delete that. What's going on here? On June 15th, the hotel agrees to pay the company a commission of $600. So we're doing business with a hotel that's doing business for on our behalf, and so we're going to collect a total amount of service revenue of $600, but it's going to come in installments. So you see 6/15, nothing happens. We basically just enter into a contract where by the time 7/15 comes around, we'll have collected a total of $600. But we have to be cognizant of how much we've earned. So if we do business from the 15th to the 30th for half of what they owe us, we have earned $300 of the $600. How do we record that if we haven't gotten the cash yet? Well, the way we do it is like this. We'll debit account receivable for how much we've earned so far, $300. And we record credit revenue or service revenue for that same amount. We've worked. That's what revenue indicates, that we've put forth time, effort, whatever. We've gone and done our thing. We've earned this, okay? We haven't gotten the cash yet. We will, but for right now, we need to record that we've earned that cash. So in this case, we're going to have service revenue. Get rid of this. Let's change all these accounts, in fact. Service revenue. We've earned how much? $300. So credit, debit, account receivable, $300. Cool. What happens when we actually collect the full amount? Well, this is where it gets a little tricky here. Okay. Now, you could do this in two different journal entries. So when you think about another half month has gone by, you could say debit account receivable, again, for the balance, $300. You could say credit service revenue for $300. You could do that, but we're going to get paid the full $600 also on June 15th or July 15th. So in which case it would be debit cash for $600 and credit account receivable for $600. So if you think about it, it's kind of like doing this. At the end, on June 30th, we record service revenue, and on July 15th, we record another $300 of service revenue. Total of that, we've earned $600. By July 15th, we will have earned a total of $600. So let me actually do that. Now, also on July 15th, we are owed, at the end of the day, we're owed another what? $300, right? So we're owed a total of $600. And in fact, what they do is they turn around and say, oh, before you go, by the way, I owe you money. And you're like, damn right you do. So what is that amount we're going to get paid? That's going to be the $600 right there. So they'll pay us $600 and we'll get cash of $600. So let's go ahead and say credit $600 and then debit the $600. So by the time that's all said and done, once they pay us, they owe us no more. We've earned a total $600. They pay us before we walk out the door, and as a result, we have a total of $600 in our pocket. That's the idea of what the authors are trying to show here, is that, look, we'll go ahead and record the revenue for whatever we've earned so far. Well, we need to make sure that at the end of the month, we update our accounts before moving on. So that's what they're showing here, is that essentially we're recording the amount that we've earned, even though we'll get cash later. Okay, service revenue, unearned service revenue. This is going to drive you nuts. If you want, and this is up to you, you can go ahead and cross this out. Do a double strike through. Make it red. Evil. And now, go back to normal. And call it unearned service deposit. Now, the reason why I say this is because I really want to make sure that you're not confusing the words revenue and expense in an account title with revenues and expenses that you typically see on an income statement. When you see unearned service revenue, this is still a balance sheet account. And what it means is we got cash, but we haven't earned it yet. We have not earned it yet before earning. So what that looks like is, and the authors, I think, give an example here. When they say somebody gave us money, debit cash, but we have not earned it yet. So the way we record this is as a liability. Go ahead and type in here, this is a liability. It's not a revenue account. Don't make that mistake, please. Even though it says unearned, unearned service revenue, the account title is supposed to indicate to you that we have not earned it yet. So where does it end up? Well, it's not a credit in revenue, it's a credit to this liability account. So that's how we represent it. Once we actually have done what we need to earn it, if we've earned half of that $400, we can go ahead and reduce the liability account. So grab this, move it over here. We can go ahead and reduce the liability account and record it as service revenue. So Control C, actual revenue. That's when we've earned it. So we had to wait for some time to go by in order to have earned that money. And sometimes it's almost like if you think about a magazine subscription, which is a classic case where the company asks you to pay for a 12-month subscription for Sports Illustrated, and you do it because you really like reading the articles in the swimsuit edition, let's just say. And Sports Illustrated is going to get all of that cash from you for that 1 year subscription up front. But they don't recognize that full amount as revenue. They show it as unearned revenue. They've gotten money from you that they have not earned yet. So over time, they will do this particular journal entry where they record a little bit at a time. That is what's called unearned service revenue, or unearned service deposit, if you will. Okay, so this is a perfect time, I think, to sort of take in all these different journal entries. And what I encourage you to do is, if you get a chance, start an Excel spreadsheet where you list off your assets, your liabilities, equity, equity, all the different equity accounts, your revenues, and your expenses. Okay? And so which type of asset accounts are being affected here? We've got cash. I think accounts receivable was affected in here someplace. Or receivables. Call it account receivable. And we got prepaid items. So I think it was prepaid rent, if I recall. Prepaid rent. Let's see, we have unearned revenue. So go down here, go unearned deposit, if you will. And we have another, let's do salary payable. That was a liability. And what else? I think that was pretty much it. But we have some revenues. So we have service revenue. And we have rent expense. So go ahead and put under equity retained earnings. All right, prepaid, cash, expense, prepaid expense, and revenue, cash, revenue, payable, cash receivable. That looks pretty good. Now, the reason why I do this is because I think this will help you better understand and sort out all the different equity accounts. And I think this is something that you're going to want to save for the future. So as you go through your notes in these various chapters, it will help you keep track of all the different account titles that we use. So this is something that I'm trying to add this year that people in the past said would have been useful. So on this side, so go ahead and make that large. And now what I want you to do is on this side here, go ahead and type in DR period, then put CR here. Now, make these somewhat together like this. What I'm going to have you do is create a data validation table. So data validation, it's actually kind of a misnomer. What you're going to do is you're going to require that only data from a particular column be inserted into certain cells. So if you click on data validation, under settings, you click list, and then select, asks you what list. Go ahead and just highlight the entire column of C right there. And then click OK. And then when it asks you, what are you debiting, you can say, well, let's see, this first one here says debit prepaid, a prepaid item. So prepaid rent is what we did. Let's go ahead and do that. Actually, you know what? Let's move this over here. I don't really like how these debits and credits are looking. Let's see, do a Control C, Control V right here. We'll just copy it, make these a little bit longer here. So here, prepaid rent, and let's see, what did we credit? We credited cash, so you can just do cash here. And you can actually shrink this up a little bit. It'll overlap. That's fine. So on this side, and if you want, go ahead and get rid of the grid lines. You go to View, unselect grid lines, your debits, and your credits. Center that. And let's go ahead and put a little line under there. Make sure we know what we're doing. Now when it comes to formatting cells, I'm not going to get into too much detail about this, but what I'll do is simply just highlight some of these, hit Control-Shift-F, number, and choose accounting, no decimals, with the $sign, OK. And here I'm going to simply say is, what do we do? This was XXX. And let's just say, what should we pay? Let's actually get the actual numbers in here. Help us remember. And we had rent, we had supplies. That was one of them too. So let's put that in there. Let's put supplies. Okay. So what was the first one we did? It was a prepaid rent. So debit, prepaid rent, credit cash. Prepaid rent, credit cash. Okay. And let's do this. Let's put this all in a box. That will be easier to sort of see what the heck's going on. Let's do. Prepaid rent of $3,000, and we'll do that. And then what we can do is we can just go copy and paste. Go to the next one, and we debit rent expense here for $1,000, credit prepaid rent. So debit. Well, that's really kind of hard to see, isn't it? Rent expense. Where are you? There you are. Rent expense, credit, prepaid rent. Cool. And for how much? In this case was only $1,000. Automatically updates. Cool. So that was that example. And we can go to supplies and do the same thing for supplies. Let me just kind of copy this, get a little space. So initially we bought supplies. I got a better idea here. Let's do this. Let's merge some of these cells. Merge, left justify. Merge, left justify. That looks better. And we can go ahead and just make that just an outline. That looks so much better. Okay. So what we can do is I can go ahead and copy this formatting down here. Okay. C, Control E. Make sure I remember what I'm doing here. We debit rent expense. Credit prepaid. There it is. Okay. I like this much better. Let's just go ahead and copy this. Paste it down here. All right, so we bought supplies. We paid cash for how much? $700. Okay. Then we consume some of them, so supplies has to go down. So let's go ahead and debit supply or credit supplies, and we're going to do. We need an expense account called supplies expense, like that, and supplies expense. Perfect. So basically just increasing that asset account, then decreasing it for what we actually consumed. In this case, it was actually $300. Perfect. Moving on down. They talk about depreciation, I believe. So we bought some equipment, accounts payable. So let's go to assets. Probably gonna need some more room here, so let's move this down. Equipment. Paid it on account. Control C. B, debit equipment, credit, not cash. In this case, it was a payable, account payable. So we can do account payable, and we'll pay them back later. We promise, we swear. Account payable, how much was it for? $24,000. We use our credit card. Maybe, hopefully. And then over time, so some time has gone by, and we have to record a little bit of depreciation expense just so that we can show that the value has decreased. So depreciation expense, $400. Well, let's go down to expenses here. Type in depreciation expense, and of course under assets we need this accum depreciation equipment. So we won't reduce the equipment account directly. So in fact, let's kind of put a little color around those. Debit depreciation expense. In credit not, we're not reducing the asset account. We're just going to stick it in a contra asset account just so that we just let people know that it's just theoretical. The equipment's still there. It has not disappeared yet. And that was for how much? $400. So cool. Moving on down. And that's how they show it. We have to worry about salary expense. So middle of the month, we actually incurred salary expense. So debit salary expense for the $900. Oh, hello. There it is, $900. And we, in this case, we actually paid, hit Alt and the down arrow if you want to go through that fast. We actually paid cash. That was for the first 15 days. Now, the next 15 days, guess what? We still had a salary expense, okay? But we didn't pay cash this time. We owe that as a liability. So we'll do salaries payable, some type of accrual for the other $900. Then, on the following day, the next month, when that happens, we're going to actually go ahead and pay cash. Cash. In this case, we're going to reduce our accrued liability, salary payable. So that goes down. So it seems kind of weird. Only one day has passed, and really we're going to accrue a liability just so that way the next day we can just go ahead and reduce it. Some of you may be looking at this saying, this seems like a waste of time. And you're not wrong. But the reality is, between these 2 days, there was a month changeover. This was all June, okay? This is July. So we have to make sure that what happens in June versus July is separate. That's why we have this, we establish this liability even if the very next day we get rid of it and pay it all in cash. We could, as a policy, if we want to avoid this headache, just make sure that people collect their paychecks before the end of the day on the 30th. That's fine too, but like I said, this is just what happens. Salary expense, salary payable, etc. Okay, perform service on account. Pay me my money. So, we had account receivable, there's that. We did some service revenue, there's that. So, we earned revenue. So, hit Alt and press down and scroll to service revenue. Now, we didn't get paid cash. We got something else of value. Account receivable. This is just for how much? $300. Then we got paid $600. So there are two, like I said, there are 2 ways of recording this. After the first 15 days, we'll record the receivable, and after the other 15 days, we can do the exact same thing. Record the receivable. Where am I? And the service revenue for the $300, and then subsequently turn around and record the cash receipt. So we debit cash, and we would credit the account receivable for $600. So do this plus this plus this 600 bucks. That's possible. It's okay to do this as like one journal entry in a day. That's okay to do. But another way of doing this is if we copy this column over and we paste it over here. And let's just go ahead and shrink this down. We can get rid of all this other information, delete it. Get rid of the lines, the formatting is not necessary. Okay. Instead of doing two journal entries, what we can do is just combine those journal entries such that, this is going to seem kind of strange at first, but go with me on this. We're going to record a debit to cash for, that seems weird, Control C. Pardon me while I fix my thing. We got cash of $600. We also, let's get rid of that. C, Control V. We also earned another service revenue of $300. And we're also going to get rid of the account receivable once they pay us of $300. So what this is doing is saying, look, we're taking the net effect of this transaction and recording it right here. It's the same information. If you break it down, there's cash for $600. There's service revenue for $300. And the net effect of this and this, we'll go ahead and put that in a fancy color to see it better. The net effect of a debit to account receivable of $300 and the credit to accounts receivable of $600 is this credit to account receivable of just $300. We can do either one of these and the information is still the same. The process by which you do the stuff in class is second in importance to making sure that ultimately the account balances are correct. Moving on from here, let's go back to our PowerPoint slide. Excuse me. The unearned service revenue. So what we did was we got cash in advance. That's fine. Someone paid us in advance. We haven't earned it yet, so we'll go ahead and record the cash. We got the cash. Debits make me happy. But we haven't earned it yet, so we'll just go ahead and call this unearned deposit, unearned service deposit, whatever you want to call it. Just something unearned. I don't like that word unearned revenue. It just is so confusing. We haven't earned it yet, so it's not service revenue. It's unearned deposit. And that was for how much? $400. I think they said after half of it was earned, what did we do? We go ahead and reduce that liability account. So that goes down by 200. And we actually get to record some revenue for $200. So it's when people give us cash, we owe them that money back until we actually perform the service. Once we perform the service, we reduce this liability account and we record the service revenue because we've earned it. Now we still have $200 left that we owe them, either in service or we have to return their money. And that's the summation of what you see here. I prefer you do this just because it's a fun exercise. It breaks up the monotony of just reading things. Plus, it gives you a little bit of exposure on how to utilize Excel to your advantage, especially when you're taking notes. And if you find it useful, great. If you don't, you don't have to do it. It's purely up to you. And I'm happy to give you more tips and tricks as we go throughout the term. So the authors now talk about how the adjusting process works. Now, I would tell you this, that what you see here as far as your adjusting journal entries, this is the majority of the work that you have to do. And it really comes down to going down your trial balance and looking at all these individual accounts one by one and asking yourself, do these need to be adjusted, yes or no? Do they need to be adjusted up or down? And the reason why is because if they do need to be adjusted, it's because of some sort of deferral or accrual or depreciation. That's it. So the question is now, how do you go about doing that? Well, it's quite simply like this. You just book a journal entry. You don't have to wait for an actual transaction to occur. A transaction like buying equipment, that seems like it makes sense. We record something. But recording a transaction when nothing has actually happened except the passage of time, this may seem a little odd to you. But think about it like this. It's almost like you have, an Outlook calendar reminder. By the way, make sure you recognize the fact that your assets are worthless. That's kind of a negative reminder, right? But that's essentially what you do. You just set up a reminder in your accounting system that says, hey, look, you need to acknowledge the fact that there's been wear and tear on your computer, your car, your bike, whatever. You need to record that depreciation expense because time has gone by. That's it. So they go through and they talk about, oh, by the way, there's this thing called income taxes. Yeah, we have to record and accrue for that as well. So let's not forget our income tax payable, and also our income tax expense. We have to pay the government something. They want our money, always. Below here, we'll debit tax expense. Ugh. And until we pay it, it's just a liability. So let's go up to our income tax payable and record that for whatever amount that is. $600. Cool. And we'll pay that later. When we actually pay it out, guess what we're going to do? We're going to credit cash, and we're going to debit the income tax payable account. So go back up to income tax liabilities here. There it is. And it'll be $600, and that's when we'll pay it. By the way, if you want to make this a little bit easier to see in the drop-down menu, obviously it picks up these gaps. That can be kind of annoying, but if you want to sort of distinguish this a little bit more, just put a bunch of dashes or tildes in front of the asset name. That way it sort of breaks up the categories a little bit easier. The same thing for liabilities, equity, so on and so on. There you go. That way when you actually pull the drop down menu, you can see it's sort of broken out a little bit, hopefully. Ew. Oh, I see why. Put these guys in the same column. Like that. Now you can do the drop down. Ah, look at that. So much nicer. Liabilities, equity, revenues. Cool. This just makes it a little bit easier to see things, I think, when you put in these extra details. All right, so we have to pay taxes. That's a necessary evil. Here's another summation of all those transactions we just went through. Here's the nature of the transactions. Here's how we break them down. What did we get? What did we give? What did we get? What did we give? It's really up to you to be able to sort through this information and make it salient in your mind. But if you have any confusion or difficulty trying to interpret a transaction and figure out what to record, just let me know. Just let me know. I'll help walk you through it. There is also this other side of things that we have not touched upon, which are the postings of all these transactions. So each one of these accounts is going to have a T account. So if you want to, you can go ahead and split the cells, split the view, that is. So go in here and hit split, and you can go ahead and grab this, put it over here, and then scroll over here. And if you're worried about running into trouble, just give yourself some lines or something. I don't know. Break it out so you're not overstepping on anything. Like a big gray. And so over here, if you want to, you can go ahead and just put in this like T account. So just merge two cells together. And then in this, you'll want to put a little line at the bottom and something over here, a little line on the side, like that. And then do the same data validation. So I think you just do Control C, Control V. Hey, that worked. So break that out to where you got, in this case, what transactions were affected. So let's draw this, move this over this way, grab the split screen, make it a little bit bigger. Hey, it's going to play around with it a little bit. It's a little frustrating at first, just trying to get the handle of how the views work. So in this case, we had prepaid rent, so what we can do is Alt down. Oh, it's not working. What the heck? Let's do data validation. List. We want this bad boy here. Oops, excuse me. We want that. Good. Okay. Now, prepaid. Oops. Prepaid rent. That was an account. Down here, we can go to the right, you can go to the left, whatever you want to do, whatever makes sense. We had cash. There you go. Just kind of format these as the same. It will help. And so what did we do? We prepaid rent was debited. So you go boom, plus. You go over here and then hit that. And then cash was credited. So you can go, well, not minus, credit, cash. That works. Actually move this up a little bit. Oh, fine, be that way. Annoying. There we go. So what I've done here is I'm trying to like line these accounts up so you can kind of see what's going on here. So debit prepaid rent, that's what that was. And let's go ahead and move this credit cash here. Perfect. And it's up to you however you want to format this. I think it's kind of fun just sort of playing around with just this different formatting stuff. So like I said, do whatever you want to do. Set up the T accounts for each one of these transactions. Format however you want. You need to add space, go for it. It will sort of help kind of get you exposed to what needs to occur as you record all your journal entries. So let's copy and paste. Control Shift plus moves things down. That works. And let's see what other account. Expense. Of course we have the expense account. Let's zoom it out. So Control C. And let's do this. Let's copy this entire column. Actually, let's do this one. Control C. Paste. And this is going to be prepaid expenses. Or rent expense in this case. Rent expense. So how did that look? We had a rent expense debit here, and we had to credit, oops, here, prepaid rent here. So if this helps you, what I'm doing here, I say go for it, do it. I'm offering you this as just a way to help you study. You don't have to do this. I know it seems kind of tedious as I'm talking my way and fumbling my way through things, but hopefully you can appreciate why I'm doing this more than anything else. These are all debits, so I'm going to put in a little finalize thing. Hit, and I'll try and introduce you to different formulas. So sum of all of this minus the sum. Actually, don't need that first. Fine. Minus sum of all of this. Nope, not you. This. Enter. $2,000 there. So my normal balance in, well, that seems weird. I gotta start off with something. Let me start off with like $10,000 cash. I need some cash, man. Copy the formatting. There we go. That looks better. So I paid $3,000. I used for rent, so there it goes away. I used $1,000, so I have $2,000 left in rent. Where the other $1,000 go, it went into rent expense. So I'm still $3,000 down. So be it. Now what we can do is copy and paste this down. Control C. Control down here. Control V. And let me give myself some. Actually, let me do this. Where is everything going? Everyone's wondering right now, what's he doing? This is crazy. C. Control V. Now I got some different accounts here. So supplies is what I use this time. So if I want, this may actually be more fun. Rather than hit the drop down arrow, I'm going to use cell referencing. This will be a lot easier. That. And that. That way I can just copy this. Yep, I want to paste over it. So I got supplies, paid cash, and there's going to be some sort of what? Oh. There's going to be some sort of supplies expense. Forgot that up here, I think. I did it. All right. So in this case, how much did I pay? Paid $700, but I got supplies. So what did I get? I got 700. What did I give? 700. And then down here, supplies expense. So this was 300. And I have less in supplies, so credit my supplies account for $300. So 400 is what I have left over, and 300 is what I've consumed. Perfect. I see what I did. I put a space here. That's the reason why this is all jacked up. So let's go ahead and add some more spaces for this guy. Down. Another thing you'll notice is that even though this may seem like a tedious exercise, you will be so much better at using Excel once you start taking notes using Excel. Just keep that in mind as you're going through this exercise. All right, we got equipment, and we paid what? Oh, it's the account payable. Interesting. Okay, so let's say we got 0 in accounts payable. Oops. Normal credit balance. And so we bought it on account. And then this is what's weird. We're not going to reduce the equipment account. Okay. We're going to, let's actually move this over to liabilities. Have a normal credit balance. So equals sum of your credits minus sum of your debits. Enter. So we have to worry about how we're going to reduce the value of equipment without directly impacting it. And the way we do that is through a contra asset account. Let's do this. Let's go ahead and insert some cells this away. There we go. And then let's copy the credit normal balance, put it here. And this is going to be accumulated depreciation, which starts off with a zero balance. And then what we do is we're not going to credit this account. We're going to credit accumulated depreciation for how much? $400, which means we need a debit depreciation expense of $400. That's what we have. That'll work. Cool. So there's a $400 debit. There's a $400 credit. And when we net these two together, the $24,000 equipment less the $400 accumulated depreciation represents the net book value of the two. So you kind of have to look at the two accounts in tandem to have a true understanding of what sort of values we have in these accounts. So let's go ahead and add some cells here. What we're going to do is copy this. This is getting crazy. Control C. And like I said, this is just how I'm doing this. It doesn't necessarily have to be how you do it. If you find an easier way, I'm always interested. So we've incurred some salary expense, and we paid out some of it in cash. So go ahead and debit salary expense and credit cash. Let's start off with, where were we at before? What was our balance before? Cash. Oh, we're on the debit side now. Okay. Let's do this. Let's move this over. Left. Cash. Whoops. It's already there. Balance. Still jacked up. Come on. There we go. And our balance in cash before was $6,300. And we're going to credit cash for $900. Ruby. Now, there was another salary expense, $900 at the end of the month, but we didn't pay it in cash. We didn't pay it in cash. We have a liability. We owe it. So let's go and put it there. Salary payable. Credit salary payable. 0. And this is going to be salary payable, $900. So you can see here that the $900 credit in cash, $900 in salary payable, that comprises the $900 in salary expense. So we're good at this point. Now we're going to, let's add some rows here. There we go. Now we're going to pay it off in the next month. So expenses are done. We've already recorded all the expenses, but we need to settle off this liability. So we're going to debit salary payable, $900, get rid of that. And we're going to credit cash, $900. So that's going to be reflected there too. So now we have no more liabilities. Whereas before, at the end of the month, we had $900. We paid that off right away. And so we paid it off with cash. All right, let's do this. Let's check to see where we're at. Accounts receivable. Move this down a little bit. There we go. Now we sold some services on account. Now we're going to do this one. Well, same way as we did it before. Let's go ahead and copy this. Paste it down here. Now we have account receivable. We have service revenue. It's a credit actually. And we're going to do cash eventually. So let's go ahead and change this to cash. And let's go ahead and make that balance from above. Service revenue is 0. Let's clear out these transactions. So we're starting fresh. Okay, so we start off, we have a debit to account receivable for 300. And we've earned service revenue credit 300. Then after another 15 days goes by, we've earned another 300 bucks. So we can say at that point, at that minute of the day, it's due to us. It's owed to us. But then guess what happens? They turn around and they say, we know we owe you 600 bucks. Let's just pay you the 600 bucks right now. So they debit the cash, 600. And they, hold on, it should be right here. We'll go ahead and reduce the accounts receivable by the 600 bucks. So now we don't owe it. Now they don't owe us anything. So, like I said, you can combine, essentially, you can combine these two transactions into one where you just have a credit for $300 over here. That would be fine too, which is what I try to demonstrate on this side, the credit for 300. This whole transaction, the effects of this transaction is still represented in this transaction, this combined transaction right here. So don't get confused too much about if I report things in a different way. It's just, it's possible to take multiple journal entries and combine them or summarize them. As long as the account balances are correct, that's all I'm really concerned about. Down, copy this, paste it here. Okay, so in this case we got some cash, but we have a liability. So let's go ahead and move that right there under deposit revenue. And, oh, for crying out loud, let's go ahead. We're going to have a bunch of credits here, so let's go ahead and move this over. So this liability, this is the unearned deposit, and this is going to be service revenue. Okay, now our credits are looking good. And let's put cash, that's our balance of cash right there. So what happens? So we got a debit of cash, 400 right there, but we now have a liability. We're on the hook now to either give it back or perform the service. So what happens? Well, we perform some of it. So service revenue, we can actually, if we go down to service revenue here, we've actually earned 200 of this, which means that we are now off the hook for $200 over here. So that's what that represents. Immediately they give us a 400. Now we owe them something. Once we perform the service, now we owe them less. We've earned that money. As time goes on, we will eventually earn all of it, but I think I just sort of cut it off right there. So, but you can go ahead and extend this problem. Let's make it a little bit bigger. And let's go ahead and just do Control C, Control V. And what this represents is the ending amount that we have earned. So let's go ahead and say debit for 200 and then credit for the other 200. So you see right here, we initially started off with $400 of a liability, and as we've earned it, we're getting relief from our liability. But just because we got the cash doesn't mean we've earned the money. We have to wait later to actually perform the services. So this deferral, if you will, is a deferred revenue account. We're deferring the recognition of revenue until we've actually earned it. We got the cash, we can use the cash, but we have to perform the service or pay them back their money. Taxes, everyone pays taxes. Everyone but General Electric pays taxes. That's a joke. Sort of. Okay. Paste that there. And income tax expense, it's a debit. Income tax payable, it's a credit. And cash will be our debit, another debit. So let's Control C, Control V, cash, balance. There you go. And let's get rid of our transactions. All right, so we have no income tax expense, but now guess what happens? The government charges us money. We have a payable now, a credit, 600, so debit credit. And then later, of course, we are going to pay them the money they want. So we'll get rid of that liability and we'll be poorer in cash of 600 bucks. There you go. If this helps you, like I said, you can skip through all this stuff if you want, but I like messing around with Excel to demonstrate some stuff. So hopefully this is helpful for you. So basically we just took everything that they're saying here and we put it in those Excel notes. So hopefully the process by which this is done, hopefully you have a little bit more appreciation that it takes a while to do this, right? So the authors are basically saying, here are the journal entries and here's the postings. And you're probably thinking, oh, that's easy. It's not easy. It takes a long time to go through and process this stuff. But once you do, then you can create the adjusted trial balance. So what this is basically taking all these different unadjusted balances and saying we need to recognize income taxes, we need to recognize salaries that we owe people. All these effects of these adjusting journal entries go in this center column here. And what we do is we quite literally just cross-foot or add a cross. That's what cross-footing means. It means you're adding a cross. We had accounts receivable of $2,200. We realized that somebody else owes us money. So we added $300. We debited that account for $300 to show our investors that we're actually owed $2,500, not $2,200. Same thing about salaries payable. We had a zero balance before, but we realized, hey, you know what? We owe some people some money at the end of the period, so we're going to credit or add to that account $900. So now we're showing our investors we have this liability that we didn't have before. This is something we owe people. So the whole idea about an adjusting trial balance is that we're showing our investors that the true nature, the true economic situation or position and performance of our company just here in this one trial balance. But rather than show them this trial balance, they may not actually get this. We'll produce this stuff individually in individual financial statements. So here's what I'm going to do. I'm going to copy this slide here, copy. And I'm going to go down to the income statement right here. And right before that, I'm going to paste that. So just hit Control V. Okay. And then what I'm going to do is I'm going to, let's see here, what do I want to do? I want to sort of zoom in a little bit here, if you will. Control X. Let's go ahead and snip tool. Grab the snipping tool. What we want to do is focus just on service revenue here, all the way across like this. Okay, and we copy that. I think what I'm going to do is go here to the income statement and hit Control V to post the snippet from the trial balance. Now, what I've done here is I'm basically showing you a snip from the trial balance, which demonstrates, look, we started off with these unadjusted balances in revenue and expenses. These are unadjusted balances. We added some, we had to include the effect of certain adjusting journal entries because, hey, look, the passage of time means that we have to recognize these items. So the ending balance now of our revenue expense accounts are all right here in the far right column of our trial balance. All we have to do to create the income statement is put these cells into an income statement. So you see already that the trial balance is almost like an income statement right here. There's revenue, there's expenses. The net of those two is going to be your net income. So going down to your income statement, you see revenue, service revenue, $7,500. Where does that come from? It comes from the trial balance. Salary expense, rent expense, all these expenses, same thing, comes from the trial balance. Income before tax, that's a subheading. There's your income tax, and there is your net income. It's all right here. It's all in the trial balance. The financial statements are just a way to sort of simplify this information and make it much more appealing in terms of readership, if you will. Let's copy this slide again, Control C, and let's go down to the statement of retained earnings. So you could say, look, I know that the income statement information goes into the statement of retained earnings, but we need to be a little bit more careful about what we're seeing too, because there's some other information in the trial balance that we need to pay attention to, and that has to do with dividends and retained earnings. So let's do this snippet here. And then let's go down here and hit Control V. And I'm going to blow this up a little bit. Like that. Put it down here. So, beginning retained earnings. So, retained earnings on the unadjusted trial balance down here is $18,800. The retained earnings account doesn't change throughout the year. We record revenues and expenses in the revenues and expense accounts. So all these revenue expense items, these accounts, are just temporary accounts. They indirectly affect retained earnings, but there's actually a process by which we close these accounts out and put them inside retained earnings. So it's kind of awkward when you're trying to learn about retained earnings and see how does revenue and expense affect retained earnings. Why don't we just book it inside the T account, retained earnings? Well, it's because retained earnings is a permanent account. We don't want to jumble it up with 5 million transactions of sales and expenses throughout the year. We want to keep the retained earnings account as simple as possible. That's why we use these temporary revenue expense T accounts. We'll keep track of all the revenues, expenses in these buckets. Then later, we'll close them out and put them into retained earnings as summary line items. There's net income, $2,900. The beginning balance of retained earnings was $18,800 as of January 1st, or in this case, May 31st. I think they're just doing a 1 month roll forward. So the beginning of the month was $18,800. We earned $2,900 in net income, and we have $3,200 of dividends declared, and that comes also from the trial balance right there. So beginning balance, net income. In fact, looking at this, let's do another snippet. You're basically taking this information, the revenue and expenses, and also taking the dividends information previously, retained earnings and dividends right here. Go back down there. So the trial point is, I'm trying to show you is that the trial balance contains everything you need to know. Revenue, all this stuff right here, all of this is the net income stuff. That's all this net income right here. So you can draw a line if you want. This line takes over here. Make that red. Make it big and bold. There it is. And then the 3,200, there it is right there. And the 18,800, that was the retained earnings, right? Beginning retained earnings. That's what that is right there. So we're kind of taking this beginning 18,800, adding revenue, subtracting expenses, subtracting off dividends. So this is like 1, 2, 3, ending balance is 18,500. That's what this is doing here. Let's copy that again. C, Control B, the balance sheet. Again, the balance sheet that we show here, and mind you, this is one format of the balance sheet. You usually see balance sheets where they have assets, then liabilities, and equity, so it's more vertical than it is horizontal. Where's all this information coming from? It's coming from the trial balance. So, snippet. Cash, salary payable, common stock, retained earnings, blah, 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 blah. Go right here. And copy that. Control V. Let's get looking crappy. Let's just put it up here to the side or something. Get out of the way. Okay, so cash, first line item, cash. Start off with 3,600. Oops, hold on a sec. That's not the right place. Control X. There we go. So cash. Trial balance, 3,600, unadjusted and adjusted. There it is. Cash, balance sheet, 3,600. Ending balance, accounts receivable, 2,500, 400, 2,000, all the way down. Accumulated depreciation, that's how they show it, etc. There's the liabilities on the right-hand side. Here's all your credits. Accounts payable, salaries payable, unearned service deposit, liabilities, all these credits. If you look at just how these things are divided up between debits and credits, you see how the balance sheet here, all this stuff on the left side, and basically your net debits right here, all this on the right-hand side, all your net credits right there. Kind of cool. All right, closing the books. Now, the biggest issue with closing the books is quite literally taking all the revenue accounts, expense accounts, and dividends, and you're going to close them out. You're going to zero out their balances. So what all this really is just kind of like purging, if you will. There's no magic behind it. It's basically saying that these are temporary accounts. We need to prepare them for next year. We need to zero them out. All the permanent accounts, the asset, liabilities, and equity accounts, they need to stay where they're at. They're just rolling forward accounting information. So what this looks like, and I don't need to go through it too much, but think about it like this. Go to the slide where they show the ledger. There's the rent expense, there's a salary expense, supplies expense, depreciation, utilities, whatever. Here's the revenue, okay? There is an adjusted balance of $1,000. So I don't really like how they show this here. Let's do this. Let's go back to your notes. Let's just copy a couple of these guys here. And let's go in here and let's actually paste it as like an embedded Excel thing. Okay, let's make it a white background so we can see it. All right, so just to kind of like make this a little bit more obvious what the heck's going on. Double click that. Opens an embedded Excel spreadsheet is basically allows you to double click it and open it up and mess around with Excel. That's what's cool about these embedded Excel spreadsheets. In fact, you see what it did was it took the entire spreadsheet. So if you don't like that, do this. Click that, delete it, go back, take whatever account, what is this, sheet 5, go copy, create a copy in a new book. Okay. And then just do, if you don't like all this other stuff, where is it? There it is. If you don't like any of this other stuff, just go ahead and just get rid of it. So this all the way over, control minus, get rid of that. Double click this split cell. Come on. The students are waiting. They want to go to bed. Holy cow. Control minus. Oh my gosh. Such a pain. Minus home. Okay. So we got these. Let's do this. We got equals. Go away. Equals sum of your credits minus sum of your debits. Enter. Yes, do it. Help me. All right, go away, go away, go away. Now let's pretend this debit account is rent expense, and I don't like you. Oh, what a pain. Oh, this is so frustrating. There we go. I will win this Excel game. All right, now we got some debits and credits. All right, so we got rent expense. Okay, and then we have, what was this? Service revenue? Okay, now what they show in the slide is rent expense at a balance of 1,000, right? So there's $1,000 debit balance in this account, right? And that's the balance prior to closing the books. And service revenue has a balance of, what was that, $7,500. So there are a bunch of credits, and the current balance is like $7,500. So think about it as like these sub balances, or these prior to closing balances like this. Okay. And what they're going to do is, I'm going to copy this and embed it and then put a white background behind it. Okay. So just going to give you an example of what's going to go on here. They're going to take these balances and they're going to say, what do I currently have in here? $1,000. I'm going to get rid of it by crediting a rent expense account. So all the expense accounts are debits. To make them go to zero, what do we have to do? Credit them to make them go to zero. What about the service revenue? Well, we have $7,500 of service revenue in this account. What do we do to make this go to zero? We debit it for $7,500. Boom, it goes to zero. Where do these debits and credits end up? Excellent question. To which I respond, they go into the retained earnings account. So if you will, paste this over here, go retained earnings, like so. And retained earnings, let's just say it has nothing. It's going to have a debit from this. So this is the credit. So what's going to do is going to have a debit for the same amount. Credit service revenue, or excuse me, credit rent expense, debit retained earnings. Service revenue is debited $7,500, so we need to credit $7,500. And there you go. Just those two accounts. That's how you get rid of them. You create journal entries that make these accounts go to zero, and they all end up inside retained earnings. That's what the authors are trying to show you in this slide, though I think it's a little bit awkward. So let me Control-C, Control-V, and I'll just get rid of this. What they're trying to do is demonstrate exactly that. There's a balance of $1,000 in rent expense. We need to get rid of it. How do we do it? We credit that account. It's a journal entry. That's all it is. So if you think about it, you're basically taking all of your service revenue account, whatever the balance is, and debiting that away to make it go to zero. Then you credit retained earnings. In fact, I'm going to go ahead and copy this and move it down like this. This is the way it should be. To demonstrate how to get everything down to zero and into retained earnings, you got to see what the journal entry is. We find out what the balance is. Service revenue has a balance of $7,500 credit. So what do we have to do? We have to debit service revenue $7,500 to make it go to zero. Now it's ready for the new year. Where does it go? Retained earnings. Same thing for all the expense accounts. They all have these debit balances. How do you get rid of them? You credit those accounts. Boom, 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 boom. And they all go to zero. And dividends also has a debit balance. We need to credit that out of there as well. Dividends, we'll credit that. That goes to zero. It goes into retained earnings. This is the reason why in the previous chapters, when they talked about retained earnings, they included the effects of revenue and expense in the account. They're trying to demonstrate that essentially when you have revenue or you have an expense, it impacts the retained earnings account. But it actually does so indirectly, not directly. At the end of the month or the end of the year, the reporting period, whatever, then we actually impact retained earnings directly by closing out all the accounts and preparing them for next month or next year. That's the process of how we get everything inside retained earnings. So that's what they're trying to show here in the retained earnings account, that we're not showing all the sales in the retained earnings, like sale, 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 sale. No, we're not going to do that. We're just going to show the sum of all the sales. Same thing with expenses. We're not going to show all the different expenses in retained earnings. We're going to show the net effect of all the expenses. So expense accounts, dividends accounts, revenues accounts, all those accounts, all they are just temporary buckets that we throw things in. We sum up all the items and then we just do one journal entry into retained earnings. That's the process of how we get all those items in retained earnings. All right. So important to know, you can keep reading on from here. Assets are reported in order of their liquidity, and cash being what is considered the most liquid of the assets. Now, liquidity is simply what is the most closest to, what sort of assets are most closely resemble cash. Well, cash is cash. That is the most liquid asset. From there, it's about accounts receivable being relatively closer to cash, inventory pretty close to cash, equipment and buildings, we'd have to sell those probably at a loss maybe to get cash. Order of liquidity is basically telling you, look, how long would it take for us to convert an asset, a non-cash asset, into cash? You need to know what this is, especially for test-taking purposes. So when it comes to converting anything that's not cash into cash, you really have to think about really what's the process. Cash is already cash, but you think about investments in stocks and bonds, there's already a stock market out there. We can just call our broker and have them sell it. Accounts receivable are fairly liquid too, because we can actually call some like J.G. Wentworth and say, hey, I'm mad and I want cash now, and simply say, look, I don't want to wait around and collect from these people that owe me. Give me my money now. I may have to take a little bit of a discount. That kind of sucks, but hey, I'll at least get my cash. We'll talk more about those in, I think, Chapter 5. But for right now, just realize that accounts receivable can be sold off or quote-unquote factored for cash. Prepaid expenses are almost impossible to turn into cash. There's some value there, but really, for all practical purposes, if you have insurance on your Toyota Camry, you cannot sell that contract to somebody who has a Ford F-150, because the insurance contract is specifically on you and your car. That's why these prepaid items are hard to sell. They're so specific. Long-term assets come after current assets. Then we go into current liabilities. Now, what I'll tell you this is current liabilities are basically debts that will be paid within 1 year. And sometimes you'll see it expressed as these are liabilities that will be satisfied with current assets. That's why they're called current liabilities, because we're going to use current assets to satisfy these. Look, at the end of the day, it's the same notion as current assets. Current assets, we're going to consume these within a year or less. Current liabilities, we're going to pay these liabilities within a year or less. That's all that really matters. Everything else is long term. If we're not going to touch these any amounts that are in long-term assets or long-term liabilities, these items should not be touched within a year, basically. Okay, if for some reason we're going to pay off a portion of our long-term liability within a year, it needs to be classified as a current liability. That's why we have classifications for notes payable short-term. There will be accounts for notes payable short-term and notes payable long-term. The portion of your debt that we pay within a year has to be classified as a current liability. Everything that's going to be paid within a year or longer, that will be long-term liabilities. So here's a classified balance sheet, and they call it classified because it's presented in this vertical format, not an account format. So this is a more typical way you see a balance sheet, and of course it looks very similar to what a trial balance looks like. So this is hopefully the trial balance, you'll find that very useful in solidifying how we present our financial information in the financial statements. Speaking of report versus account format, you need to be aware that there are different ways of presenting financial statements. So most income statements that show the revenues and expenses are presented in a multi-step format, basically meaning there's multiple subheadings. A single step income statement basically shows all the revenue gains at the top, all the expenses and losses at the bottom, and it's so poorly formatted. It's so uninformative that it's almost not even worth discussing nowadays. We have to tell you about these because there is a format called single step, but nobody uses it. And the reason why it's not informative, you want to use a multi-step format where you show all the things that you did, the what money you deliberately tried to earn, the expenses you had to incur to get that revenue, and any type of incidental revenue gains, expenses, losses towards the bottom. That's what a multi-step income statement does. It sorts the deliberate activities towards the top and the incidental or unintentional activities towards the bottom, because people read top to bottom and they emphasize the most important stuff at the top, less important stuff towards the bottom. That's what a multi-step is all about. Balance sheets, usually you see it as the report format, this sort of top to bottom way. What we've done so far in accounting is we've shown balance sheets where they have the assets on the left and the liabilities and shareholders' equity on the right. You don't really see this too much. It's a pretty rare phenomenon. So just kind of get used to seeing, again, we'll just sort of put that in red, double strike through. Primarily you see balance sheets in report format and income statements in multi-step format. I'll let you read through these next slides that talk about analyzing the financial statements. In this case, for you finance majors, you're going to want to pay attention to these ratios and these financial analysis discussions towards the end of the chapter, because you're going to see these over and over again. The essence, I'll tell you this, you can read the stuff on your own, but essentially what you want to know is, how does a company's balance of, say, their current assets, their current liabilities, their total assets, or total liabilities, what does that mean? Is that valuable information? If I just look at a number, 15,176, is that a lot or a little? Really what it comes down to is how we scale these items. Scaling is essentially what puts things in perspective. If we want to look at, say for instance, our ability to pay our current liabilities, we would want to look at our current assets and say, how much do we have in cash, inventory, accounts receivable to pay off all of our accounts payable, salaries payable, utilities payable. That's important to know. If we have a ratio above 1, that means we have at least enough to cover all of our current liabilities. If we take on more debt or we bring in more cash, what's the effect of that? Are we better off or are we worse off? So these ratios help us sort of gauge the sensitivity to economic fluctuations and changes in our own strategy, if you will. So taking a look at through these ratios, I'll let you know if there's a specific ratio that you need to remember for the exam. But aside from that, this is really what financial analysis is all about. And Chapter 13 will talk all about this again.